This is our video lecture for chapter number 3, where we're continuing to prepare financial statements, financial reports for our company. But before you can prepare the financial statements, you need to make sure that your accounts are updated and correct. So what we're going to do just before preparing the financial statements is record more journal entries to adjust accounts to properly reflect what there should be, what the balances should be. So we have different periods of time we can prepare financial statements for. Definitely you want to prepare a financial statement at the end of the year so it can help you prepare your income tax forms, your income tax returns. But some companies need to prepare financial statements more often. For example, if you're a publicly traded company on a stock exchange, probably you need to prepare quarterly financial statements. So you hear in the news all the time, when it reaches the end of the quarter, a company will report their profits for the quarter. And definitely you need a financial statement at the end of each quarter to determine how much profits they have. Or in our example, we've been preparing financial statements at the end of each month. So just before you prepare the financial statements, you gotta make sure your accounts are updated and accurate. So here in chapter 3, at the very end of the period, at the very end of the accounting period, we're gonna be preparing, journalizing more journal entries, but they're called adjustments. And we have to follow accounting rules, and the main accounting rule we're applying throughout the whole semester is called accrual basis method of accounting, where revenues are recorded, journalized, not when you collect the money, but when the revenue is earned. So typically when you do the work, do the service, sell the merchandise, that's when you earn it, and that's when the revenue is going to be recorded, going to be credited, and not necessarily when you collect the money. In the case of expenses, expenses are recorded, or here recognized, when incurred. Now what is this word incurred? Well, most people say when it happens. So when does it happen? When does an expense happen? Basically, an expense is cost that is used up. So when a cost is used up, that's when we record the expense. So if you buy some supplies and you don't use it up, there's no expense yet to report. Okay, we're going to see costs can either be an asset. Asset has values. Assets are going to be used up in the future. Or if the cost is already used up, here we're going to classify it, record it as an expense. Another type of cost is when you pay out maybe money to the owner, and that's called a dividend. So we'll see assets eventually will be turned into expense when this asset cost is used up. So maybe as an adjustment, that's what we're going to be doing, converting the asset cost into an expense cost because we've incurred, we've used up that cost. Now another method of accounting that may not be that common, well, it is very common in terms of use because you probably use this, is called cash basis. So you report your income revenue when you collect the money, the cash, and you report expenses or deductions when you pay out the cash. But cash basis is not acceptable for most business financial statements. So here it says it's not a generally acceptable accounting principle, not an accounting rule. So what we're learning and applying throughout the whole semester is accrual basis method of accounting. So here's an example comparing accrual and cash basis. So our company has bought an insurance policy for a cost of $2,400 here at the end of December, in December 2011. So if you treat this as an expense for December, you're going to be overcharging this month or the whole year 2011 for costs that's going to be benefiting over the next 2 years or the next 24 months. So the proper way to report this cost is to set up an asset when you buy it, and then over the next 24 months, each month you're going to make an adjustment before preparing each month's financial statements, recording $100 of the insurance being used. Again, you set up an asset here for $2,400, insurance prepaid asset, and then every month as an adjustment, you're not going to get a bill. You already paid off the whole bill, right? But you're going to make an adjustment of $100 recording insurance expense being used up. Here you can see it's used up by the end of the 24 months, the 2 years. So accrue basis says you don't record the expense when paid, you record the expense when incurred or when it's used up. So here is the 4 different types of adjustments you can have. Now I'm not going to have you memorize this because you can pretty much just look at your textbook to determine which type it is. Yeah, all I want you to do for now is to be able to journalize, to record debits and credits for these adjustments. So here's an example we just saw. We had set up an insurance asset when we bought it, and for every month that benefits for the insurance, we're going to reduce the asset credit, but at the same time record the cost being used up, debit insurance expense. Here's another example of using supplies. So the company bought $15,500 of supplies during our year. That's our accounting period, the whole year. And every time you took out supplies, here you can see the amount going in debit, and every time you used up supplies, you didn't reduce this account. Okay, you just increased it every year when you bought with a debit. But now we know at the end of the year this number is not correct, not updated. So what we gotta do is record an adjustment. The only way you change an account is with journalizing a debit or credit. So here's our adjusting entry. We know here we went through the company and counted how much supplies we still have on hand. 2,655 should be the balance we have left over in the supply asset account. Remember, assets, the normal balance is the same way we increase it with debits. So to decrease this supply asset, we gotta credit the supplies here for the difference between what we have had and what we have now, yeah, left over. So here's a credit being posted to the ledger T account here. And the offsetting debit is the used up expense. Expenses are recorded with debits. Here you can see the posting into the T account. Another example of an asset being used up is called depreciation. Depreciation applies, let me get my pen back here. Depreciation applies to assets that last a long time, called plant assets. So an example of a plant asset would be a building or equipment or an automobile. Again, it's going to last a long time and has a relatively high value. So we set up the asset when we first buy it. Now when we start using it, the wear and tear of that asset, we call that depreciation, which is an expense. So here's a formula to calculate out depreciation, and we'll see other formulas in a future chapter. This is the simplest one, called straight line, where we take the original cost of the asset and we estimate how much we're going to be able to sell it for when we're through with it, called salvage or residual value. We take the difference, and that difference is now going to be deducted as an expense, depreciation expense, over the whole life we're going to be using this asset. Okay, so in an example here we have the cost of buying the asset, $62,000. That's equipment. It's going to be worth maybe $2,000. This is just an estimate at the end of its life we're going to be using it for, which is 5 years. So the formula is to take the cost, minus out that salvage value, and the remaining cost of $60,000 is now going to be used over 5 years, or $12,000 per year. This is going to be our depreciation adjustment at the end of each year. So at the end of the year, here we record depreciation expense for it being used up. But notice now the credit is going to go to a new account, not equipment, but an account called accumulated depreciation for equipment. So let me illustrate these amounts by setting up T accounts. So here is our equipment account asset, and when we bought the equipment here for $62,000, we debited that equipment account, increasing it. And now when we start using up the equipment, we know that used up means depreciation expense. Expenses are recorded with debit, and here after 1 year's worth, $12,000 goes in here. Now the logical thing to say is that we're using up this asset, so we should be crediting the asset. But in the case of plant assets, sometimes we call it fixed assets, we always want to know the original costs. So instead of reducing this cost account, what we do instead is set up a neighboring account called accumulated, here A/D, accumulated depreciation for the equipment. So every time we start using up this account, instead of crediting the account directly, we're going to put the credit in this account here, 12,000. So debit, credit, yeah, post the debit, and here post this credit to this new, we call it contra asset. Here's an asset increase with a debit, and here's the related contra asset increase with a credit. Now if you ask me how much of this equipment I have left over, what you gotta do is take the original cost, debit, and combine it with this usage account, accumulated depreciation, which is a credit. And we know when we combine debits and credits, you don't add them, yeah? You subtract them to show a difference of $50,000. That difference is called, probably you know the term or heard the term called book value. The book value of this equipment is $50,000. And every year, until we get rid of this equipment, we're going to record this adjusting entry at the end of each year, increasing this accumulated depreciation by another 12,000. So now what you have left over, what is that, 48 or 38? Anyway, this 2 minus this is the book value after 2 years. Every year the accumulated depreciation will increase. Every year the difference, the book value, will decrease. So when you prepare one of your financial statements, the balance sheet, you're going to show your assets including the equipment at the original cost, and you're going to subtract out here in the asset section the related contra asset accumulated depreciation. Again, debit, credit. This is not a debit credit column now, this is just a grouping column, so you get the subtotal here. When we combine debits and credits, we know the difference, we take the difference, and here's the book value of that equipment now going to be added to the other assets to get the total assets on our balance sheet. Another type of adjustment relates to the unearned revenue account. Remember, whenever you hear the word unearned, you're dealing with a liability because customers had paid you money in advance and you owe them some type of service or merchandise, and you cannot report any revenue yet. Yeah, again, this unearned revenue is a liability account. Liabilities are increased with credits. But as you do the work, you're going to reduce the amount you owe your customer. You're going to be debiting the liability, and because as you do the work, that means you earned it, increasing revenue at the same time. So we had an example here for a college or university, Ox University. They sold 1,000 season tickets, and each ticket allowed the bearer to go to 20 home basketball games, and the cost of these season tickets were $100 each. So the total amount of cash being collected is $100,000 debit cash, and the credit cannot be going to a revenue account. Remember, unearned here means that this is a liability account. We owe the ticket buyers $100,000 worth of admission, and you only earn this money as the games progress, as you give admission to those ticket holders. Okay, so right now we're increasing this liability with a credit of $100,000. This is back on October 1st when you sold and collected the money for those season tickets. Now by the end of the year, before you prepare your financial statement here on December 31st, you have played 10 of the 20 games, so you've earned half of that money that you collected in advance. This winning and losing record doesn't mean anything in terms of accounting. Maybe you should be recording a loss if you have more losses, yeah? But anyway, half of this 100,000 is now earned, and you don't owe a whole 100,000 worth of admission anymore, so you got to reduce this liability. The only way you reduce or increase accounts is by journalizing, and we know reduced liabilities with debits, here debiting for half of that liability, leaving a balance for the remaining 10 games of the season for a future admission. When you debited this account, you know you also have to credit another account. And because we did now earn that 10 games worth of admission, here is a revenue account called basketball revenue being increased with a credit. Here I'm posting it to my ledger account. Another type of account is kind of something we've already are familiar with, recording maybe a bill, but sometimes you don't get a bill to have an expense being recorded. Here's an example where we have employees working for us, and every Friday is their payday. And the last payday of the year, well, the last payday is back on the previous Thursday. Let's see if I can get more information here. Here on December 25th, on Christmas Day, they got their last paycheck of the year. But the next Friday, they'll get their paycheck, but the next Friday is next year. But here's your year end. And it's time to make adjustments right here. The employees have been working this past last week of the year, and here they say they've earned $47,250. And as of the end of the year, you haven't paid it yet because it's not payday. Here, payday will be a couple days later. Here, but a couple days later is next year. So what you gotta do is record this amount being earned by the employees as an expense for the 2011 year. Okay, before you prepare the 2011 financial statements. So you gotta make an adjustment. I'll tell you what, let's say that you regularly pay them $50,000 per week. So this $50,000 paid here would have been debiting salary or wage expense like we've seen before and crediting cash. Here you're going to be debiting salary expense for $47,250, but you're not going to credit cash because the cash is going to be spent over here on payday. So we learn to accrue this expense by not crediting cash but crediting a liability here called salary payable. We owe this amount of salary to our employees at the end of the year, December 31st. So you can see this expense being posted with all this other money you paid the employees during the year. This you didn't pay yet, but here's the total they had earned for the whole year. And of this amount you didn't pay, you post the liability to the salary payable liability account. So let's say that a couple days pass by and then it's Friday in 2011. That's January, let's see, that's Thursday. So Friday would be I guess the 1st, yeah? January 1st of 2012. And you're going to pay them their regular, let's say $50,000 of pay. Really what you're paying here on this date is this amount here plus their Friday pay. So if I were to journalize the entry the very next day for the January pay, January 1st, 2012, I would be debiting this salary payable, paying off this liability for $47,250, and for the Friday pay I would be debiting salary expense. Now remember, this expense is for the 2012 and not 2011, like this $47,250. How much is that? $2,750. And I would be crediting cash for the regular $50,000 that they collect on every payday. So you notice when you pay this cashier, it's really for two different things: the pay that you accrued for last year and the pay for this year, just one day, January 1st pay of 2012. Accrued revenue, just the opposite now. You're recording revenue, not an expense. So the typical situation is you complete the work, you make the sale, and you bill your customer. You don't wait to collect the money. So in our case here, our CPA firm had done some $31,200 worth of work, and we haven't billed the customer yet, but we did the work and the customer owes us. So here is the revenue we've earned, and not debiting cash because we haven't even given them the bill yet. They don't even know they owe us this money, but we do know it. So we debit, increase the right to receive the money. Accounts receivable asset increase with debit. And here you can see the posting. So here the total amount now owed by customers at the end of the year, including this amount that was accrued, plus the amount being earned, posted with all the other revenue we've earned during this year. Again, here's a summary of the different types of adjusting entries. But what I'm interested in is that if you can do this here, knowing what to debit and what to credit for each type of adjustment. What accountants really use a lot is the Excel spreadsheet. So here's an example of a spreadsheet where we pull the balances from that journal ledger to make a trial balance that we're familiar with from the last chapter 2. Remember, here in this column would be asset type accounts. This is the dividend, and then the expenses all increase with debits. And in this column would be liabilities, anything payable, unearned, common stock, revenue accounts. Also now new to our credit normal balance is that contra asset, the accumulated depreciation here. And instead of making journal entries right away for adjustments, accountants may kind of play around with this next two columns. So here you can see an A $100 debit and here an A $100 credit going to those two accounts we saw for the insurance. Remember, the insurance of $100 being used up every year. So you put your adjustments matching them, but with the letters A debit, A credit, A debit, A credit. And when you add and subtract across, you know a debit and a debit will equal a bigger debit, right? And a credit plus a credit will be a bigger credit. But if you have a debit here and a credit here, you would take the difference. Here, more debit than credit, so the difference is a debit. Or if you have a debit here and a credit here, you would take the difference, right? And whatever is bigger, debit or credit. But just like the trial balance here, matching totals, just like the adjustment, A debit equal A credit, has matching totals, this trial balance, after adjustments are added in or subtracted out, have to equal debits and credits. Now it's this adjusted trial balance you can prepare your financial statements. Here's your trial balance. You take your revenue and your expenses and you reformat it in the income statement financial statement, showing now the difference between revenue and expenses is your profit or net income. And with this net income, you can prepare the second financial statement, the retained earnings, where you have your previous profits plus the current year or current month's profits, minusing out any dividends you paid out. This is not an expense now. Let me go back to the trial balance. Here's expenses and here's that dividend. Notice how it's subtracted from the other amounts here, which are credits. This is a net credit for net income, leaving you a balance in the retained earnings account. Now retained earnings, if I go back to this trial balance, do you see retained earnings here? 0. But how come we show retained earnings of $31.85 here? Well, really what's happening is all the revenue and all the expenses and minusing the dividends are squished together to come out with the retained earnings figure. And the retained earnings account is still 0. Because we haven't debited or credited the retained earnings account yet. We'll see it in a couple minutes. Next financial statement is the balance sheet, where we have assets, everything we own, including that equipment at the original cost of $26,000, minusing that new contra asset. Remember, this is a credit, combining it to get the book value, the remaining costs, undepreciated costs, adding it to the other assets to get the total assets. Then liabilities, including the unearned revenue account, equals total liabilities here, and common stock. And notice retained earnings again. That's coming from that previous retained earnings statement. In the ledger account, all the T's, the retained earning is still 0. That's why we had to prepare this before doing this here on the balance sheet. And here's our test, total assets equal liabilities plus the equity. Now we gotta get ready for the next year or the next month to get a fresh start. So what we're gonna do is close or zero out what we call temporary or nominal accounts and not change any real or permanent accounts. So the first temporary set of accounts we're going to close out or zero out is revenue, because we want a fresh start of zero at the beginning of the next month or next year's revenue, zero for the next month's or the next year's expenses. Both of these two are going to be closed or moved into a temporary account called income summary. This is the only time you're going to see this account, income summary, when we close out the revenue and expenses. And then the income summary and the dividend accounts will be closed out into the retained earnings, updating retained earnings. So here's a simple example. We just have one revenue account and one expense account. Notice the normal balance revenue credit, normal balance expense debit. So we said revenue close out first, number 1, expense closed out number 2. Both of these two close out into income summary, and income summary close out number 3 into retained earnings. Because the revenue has a credit balance, the way to zero or reduce it is something we've never done before. Debit revenue for the full amount in here, the balance. And every time we debit one account, we know we got to credit another account, in this case this new temporary account called income summary. So right now revenue is 0. Income summary has increased by $25,000. The next step is to close out the debit balance in the expenses. And here's something we've never seen before. Reducing an expense with a credit. This is our closing entry number 2. At the same time, we're debiting that new income summary account. So now expenses are 0 and revenue is closed out. And income summary has a balance equal to the company's net income. Revenue credit minus expenses debit. Sorry, I can't do that in my head, but right here is a balance of net income for the whole year or the whole month, whatever period we're working with. So the third step is now to close out the income summary account. Here you can see that balance of net income was $6,900 credit. So you got to debit this account. This is the retained earnings we're going to be closing out. This is already what's something in there. In the examples we've seen, it was 0, but here they assume it's from the previous years or years of $7,000. Now we're going to move this $6,900 into retained earnings. And the way you reduce any account with a credit balance is to debit that account. And then when you debit, at the same time, you know you got to credit another account. In this case, increasing retained earnings, adding this year's profits to the previous year's profits. So the last account we close out is dividends. So during the year, we paid out $2,000 back to the shareholders. And again, we want a fresh start of 0 in here for next month or next year. And the way to reduce this debit is to put credits in here. And at the same time we credit, we know we have to debit another account, in this case retained earnings. Dividends come from profits, from earnings. So now you're reducing the earnings with this debit. And whatever balance you have here, it won't match up our previous example because they were using different numbers. But this would be the retained earnings showing up on the balance sheet. This would be the retained earnings showing up on that statement of retained earnings. And now, because you've changed the balances in that ledger, you journalized the closing entries and you posted them to the ledger, you have new balances in the ledger. You have to make another trial balance. So here's a summary of all the different steps we've gone through for the whole month or the whole year. We had source documents we analyzed to determine what's happening to the accounts, being increased or decreased. And here's the first place you record the debits and credits. You journalize. This should maybe be called transactions. Yeah. We journalize transactions in the general journal, recording debits and credits. Then we post all those journal entries into the ledger. I guess we're missing this this word here, ledger. It's a or R. Anyway, you guys can figure it out. And let's see. Once you update all the ledger balances, you prepare that initial trial balance, testing whether total debit balances equal total credits. And then here the topic for chapter 3 is to update and correct the balances by journalizing, not transactions, but adjustments. And you post those adjustments to the same ledger. You journalize these adjustments in the same journal here as the transactions. So it's kind of misleading to show all these different squares here. Yeah, you're working with the same documents: general journal, journalize transactions, journalize adjustments, post the transactions, post the adjustments to the general ledger. Now you prepare another trial balance, this time called adjusted, from which you can prepare those periodic financial statements: income statement, statement of retained earnings, and balance sheet. Now to get ready for the next period, so you can start this whole cycle over again, you have to update and close out certain accounts. Remember, revenue, expenses, dividends close out eventually into the income, into the retained earnings. So you have to journalize in the general journal those entries, and you post them to the ledger. And now you have new balances in here, and you make another trial balance, testing whether the total balances in here, the debits and credits, are equal. And now you're ready for the next cycle. This reversing entries is something optional, covered in the appendix. I don't expect you to really read that, unless maybe you have a question on the exam, then you can refer to it. Appendix at the end of chapter 3. One more thing about this chapter 3 is to look at your balance sheet and classify, to group it into certain categories. So the assets have a couple different categories. The first set are called current. Currents are the very liquid. Definitely cash will always be first. And then the next best thing to cash would be receivables from other people, or assets that can be used up fast, like supplies or inventory, or even that prepaid insurance we saw. And then the long-term type assets here, like investments in other companies that you don't plan to sell, or here's that equipment and building. We'll talk about intangibles in a future chapter. On the other side of the balance sheet, remember, this is like our accounting equation: assets equal liabilities plus equity. The liabilities are divided up into two sections. Ones that have to be paid off relatively early, within a year, we call that current, and ones that are paid off beyond a year's time, called non-current or long-term. And then our equity would be the common stock and the retained earnings we saw. Okay, so taking a look at an example, let's look at an example here. Current assets are these right here. Cash is always first, and the next best thing to cash. Maybe you will have even some short-term investments you can sell over here. Supplies can be used up real fast. Insurance is used up relatively fast. We take a subtotal, and then the long-term, or here plant and equipment assets. Here's the cost of the original equipment, minusing out that new accumulated depreciation account, the contra asset we learned here in chapter 3, to get the book value that we add to the other assets to get total assets. Then liabilities that are paid off quickly, called current. Looks like we don't have any non-current or long-term liabilities here in our company's balance sheet. Then equity would be common stock and retained earnings. Again, matching totals here. Now, to determine whether things are good or bad, we want to compare amounts among the financial statements. So here at the end of chapter 3, we have something called ratios. So one ratio would take the net income at the bottom of the income statement and divide it by the net sales at the top of the income statement. This is your revenue here, or total revenue. And this is basically, answer would be some kind of percentage profit margin. So let's say your sales were $100. Could be $1 billion, but I'm just assuming it's 100 to make it easy to change to a percent. And your bottom line shows $4. This is telling you your profit margin is $4. For every dollar sale you have 4 cents of net income. For every $100 sales, you have $4 of profit. For every $100 million of sales, you have $4 million of net income profit, which is pretty good for a retail type company. And if you look at a company like Apple, for every $100 sales, their net income is more like $25, which is really high. And that's why the cost or price of Apple shares of stock is very expensive. the anticipation is that they're going to have lots and lots of income, big income compared to their sales. Another type of ratio we can determine the health of a company is to take all the assets that are relatively liquid, cash, receivables, supplies, and divide it by the bills that have to be paid off relatively soon. Typically, current assets are assets that can be used up or converted into cash within a year's time. Likewise, current liabilities are bills that have to be paid off within a year's time. Both are subtotals on the balance sheet, and a good current ratio is something like $2 of current assets for every $1 of current liability, or we say 2 to 1. Yeah, we have $2 of current assets for every $1 current liability. So generally, not always the case, this would be a good current ratio. If you get 1 to 1 or maybe a 0.5 to 1, this would be a warning that something's going to go bad on you. You won't have enough money to pay off the bills that are coming due soon. Okay. So this is the end of chapter 3. Make sure you do your Learn Smart questions, your homework problems, and you definitely got to read the chapter to understand the material. If you don't read, it's going to be a wake-up call when you take the exam. Okay, talk to you later.